Welcome to This Explainer. Today we're diving into the thrilling and, yeah, let's be totally honest, sometimes overwhelming journey of buying a home right here in Kansas. If you've been scrolling through listings, mentally arranging your furniture in that perfect living room, you already know the feeling. But hey, before we get too far ahead of ourselves, we really need to talk about the numbers. So let's just jump right in and see exactly why using a localized Kansas mortgage calculator is literally the most important first step you can take toward homeownership. So, is your dream home within your actual budget? It's such a simple question, right? But man, it can cause a whole lot of anxiety. It is so easy to fall head over heels for a property, but you'd be surprised how many buyers end up feeling totally blinded when they discover the hidden costs of owning a home. That sticker price you see, that's really just the tip of the iceberg. And if you aren't prepped for those hidden housing costs, your dream can turn into a pretty stressful reality real quick.
Section 1. The hidden costs, building your financial bridge.
There's a core philosophy we absolutely need to adopt right out of the gate here. Financial planning is the bridge between your current savings and your future homeownership goals. Before you even think about looking at another property listing, and definitely before you go chat with a lender, you've got to lay down a rock-solid financial foundation. Because honestly, if that foundation isn't there, the whole bridge just collapses.
And this right here is where your most powerful weapon comes into play. A Kansas-specific mortgage calculator. It's a tool that models debt obligations by combining loan amounts, interest rates, and terms into a clear monthly payment plan. But really, it's not just some random piece of software. Think of it as your digital shield. It's your ultimate guide through the local real estate market, translating all that clunky financial jargon into a crystal clear payment plan. It is an absolute prerequisite before making an offer.
Using this tool brings 3 massive, confidence-boosting benefits. First up, budget visualization. You get to see exactly how a massive price tag actually fits into your real day-to-day monthly life. Second, data-driven decisions. You can map out different loans to see the true cost of borrowing over a couple of decades. And third, lender readiness. By the time you finally sit down with a lender, you already know your exact numbers. You aren't going in there asking for permission. You're confidently telling them what you need.
Section 2. Anatomy of a payment, beyond the principal.
Now, if you think your mortgage is just paying back the money you borrowed, we need to recalibrate a bit. Industry insiders talk about something called PTI. Basically, your monthly obligation is a pie made up of 4 slices. You've got the principal and interest, which is your base loan repayment. But then you also have property taxes, which is a local government levy. You have homeowners insurance to protect the place. And finally, if your down payment was less than 20%, you get hit with private mortgage insurance, or PMI. PMI is an extra cost that protects the lender, not you, and it just eats right into your budget until you build up enough equity in the house.
So, why do you need a calculator specifically tuned for Kansas? Well, this is absolutely crucial. Generic national calculators often get property taxes completely wrong. Take Johnson County, for example. They have an average property tax rate of about 1.17%. If you use a standard online tool that assumes some generic national average, your monthly budget projection could be off by hundreds of dollars every single month. Those local details, they matter immensely.
Section 3. The details matter. How small tweaks change everything.
Let's look at a concrete scenario to see how these seemingly minor tweaks create massive financial ripples. Imagine you're eyeing a $250,000 home. If you only put 5% down, your loan amount sits at $237,500. Plus, remember that extra PMI fee we talked about? You'll be paying that every month. But what if you push that down payment to 20%? Suddenly, your loan drops to an even $200,000. Not only are you paying interest on a much smaller balance, but you completely avoid that PMI trap altogether. A good calculator shows you this mathematical reality in literally seconds.
Okay, so here are the actual levers you can pull when you're modeling your purchase. As we just saw, aiming for a 20% down payment is ideal to avoid PMI. Next up, your credit score. This is basically a primary indicator of your financial reliability. Bumping it up can unlock lower interest rates that will easily save you tens of thousands of dollars over the life of the loan. Third, only borrow what you need. Just because a bank approves you for $500,000 definitely doesn't mean you should spend it all. And finally, use all this data you've gathered to shop around for the best interest rates.
You've also got to decide on your timeline. In the U.S. market, you're typically looking at either a 15 or 30-year term. Now, a 15-year term means a higher monthly payment, but you pay drastically less total interest to the bank over time. A 30-year term, on the other hand, gives you a lower, much more budget-friendly monthly payment. It makes your day-to-day life a bit easier, but you're going to pay way more in interest in the long run.
By running both of these scenarios through your calculator, you can visually see this critical trade-off between time and your long-term costs.
Section 4. Avoiding the trap. Staying financially healthy.
Because at the end of the day, buying a house should be a blessing, not a curse, right? Which brings us to the golden rule of real estate affordability, the 28-36 rule. Financial experts strongly recommend that your total housing costs, remember that full PITI pie from earlier, should never exceed 28% of your gross income. Furthermore, your total debt, meaning your new mortgage, plus student loans, car payments, credit cards, the whole shebang, shouldn't cross the 36% threshold. Sticking to these calculations ensures you actually have money left over for emergencies, groceries, or, retirement. It basically keeps you from falling into that awful trap of becoming house poor.
Now, I know what you might be thinking. What happens if market conditions aren't exactly perfect right now? Well, there's this memorable piece of real estate wisdom that goes, date the rate and marry the house. Look, you can't control national economic policy, and waiting around for the quote-unquote perfect market is a game you might never actually win. The real goal is to secure a home you love, where it is, how it looks, at a price your calculator proves you can comfortably afford today. If interest rates drop down the road, great, you can always refinance. So you date the rate, but you are absolutely married to the property itself.
So what's the big takeaway here? Let's give you a concrete step-by-step action plan. Step 1. Gather up all your financial papers and check your credit report, so you're working with accurate data. Step 2. Take those exact numbers and plug them straight into a Kansas-specific mortgage calculator to compare different scenarios, rates, and terms. And Step 3. Once your budget is completely locked in, go ahead and consult some local lenders to get that pre-approval letter.
Ultimately, using a mortgage calculator isn't just about doing a bunch of math. It's truly about empowerment. It protects your budget, completely removes the guesswork, and turns a notoriously stressful process into a smart, strategic plan. So I'm going to leave you with this final thought. Are you going to keep guessing and hoping for the best? Are you ready to actually build your financial bridge today? Dive in, run your numbers, and take control of your path to homeownership.